John, in the greater scheme of things, do dividend outflows have much of an impact on the currency?
No. They're not a very volatile component of the balance of payments whatsoever. So yes, we do have a steady outflow of money, and that has been increasing over the years because of foreign direct investment and foreign stock investment. But it's not something that drives the rand from one quarter to the other. But underlying it, yes, it is an important component of the balance of payments.
And of course, we do want these foreigners coming into our market, particularly those with long-term money, don't we, Sasha?
Exactly. I mean, you can look back in history and you can see other people had the same anxieties as ourselves. You know, the Americans, when they first gained independence, the biggest owners of their fixed income and equities market was actually the Brits, you know. So they had those same anxieties, and it takes foreign investors to come into your market to be able to spur the locals to greater ownership of their own market, ironically. Because if you look, or if you start out with a whole lot of state entities, as in the case of, say, for instance, Japan or South Korea. So, you know, we want these foreigners here to be owning our equities. And I think a lot of the reason is for the greater dividends that we had in a time where government bonds, particularly in the developed world, let's say in the high quality developed world, were yielding much higher. Much lower, and also because cash rates were next to nothing. So people were in this global search for yield, and that gave our companies a slight higher valuation because they'd traditionally always been good dividend payers, the good ones at least.
At the same time, we have South African investors buying more offshore funds, investing more money offshore. We've had relaxation of exchange controls, which allows us to take more money offshore. Are we starting to see dividend inflows starting to match the dividend outflows, John?
No, not to nearly the same extent. Foreigners own perhaps 40+% of the local stock exchange. By contrast, South African institutions, as we all know, have been very limited in the cash that they can take offshore, and so the dividend inflows certainly don't completely offset the dividend outflows, maybe 1/4 in terms of the absolute size. So over time, hopefully that can change. South Africans as investors, we need to diversify offshore, just like all investors, and that should increase those inflows from offshore.
Now, John very kindly gave me some numbers yesterday afternoon just to illustrate. 79 billion rand dividend outflow in 2007. That fell to 74 billion in 2008, 52 billion in 2009, 53 billion last year, Sasha. But we are looking at companies starting to recover. Lots of companies cut their dividends altogether. Dividends are expected to grow this year as well. What sort of growth would you expect in profits and dividends from South African companies this year?
Yeah, look, forecasting is as good as telling you what the weather is going to be a little bit later Friday. Yeah, no, look, I mean, on balance, if you have a look at long-term trends, the growth in the Johannesburg Stock Exchange has been between 15% and 18%, and that's largely earnings-driven. And by a function of having higher earnings, if companies keep their payout ratios or their dividend cover the same, then you should expect something in the region of 15 to 20% per annum. And that's over a longer period if you stretch it out post World War II, in our equities market specifically. So I think if things have normalized, we've returned to a level where valuations don't look wildly expensive, and they don't look wildly cheap ever. You know, if anyone could have stuck up a flag in March 2009 and said, hey boys, here's a generational buying opportunity, people probably wouldn't have believed you, because they would have, we in our own client base, we had people phone us and say, oh no, we feel things are going to get better. Meanwhile, I think it was Barack Obama who on that Friday afternoon said, oh, even in his world, following a Bernanke speech, stocks look cheap. So I don't think you're going to get the same sort of valuations that you're going to get back then. But there are still companies in a sweet spot which still have very attractive yields. I would say you must also be careful, because you could fall into a trap of, say, for instance, looking at Telkom and saying, oh, well, on a historical basis, this stock looks dirt cheap, and look, it's going to pay a great yield. But I think, the margin compression plus revenues crimping, don't get caught in that. So look for a steady run-of-the-mill company that's growing revenue nicely, that's had a history over the last 5 years, even with this big speed bump of having a better dividend payout ratio. I would say a company that probably falls into that category is a competitor of theirs, MTN.
You have to look at it from both sides, though, don't you, John? Because, I mean, we have those short-term portfolio inflows, which can just as easily, or as we have seen this year, flow back out of the country. There's also longer-term investments, such as Barclays buying a stake in Absa, or Walmart buying a stake in Massmart. So you get a great lump of sum of money in at one point, perhaps 20 billion rand, but you are looking at dividends flowing out forever afterwards. Is this a net neutral effect in the long term?
Well, I mean, as you were saying earlier, South Africa does want foreign direct investment. There's a lot of positives that go with FDI, skills transfer, improving...
In the case of Barclays, exactly.
Well, that's a competitor, so I'm not going to agree with you. But just in general, it does help improve South Africa's economy. But as you say, the cost is a constant dividend outflow that happens with time. So yes, we do want that FDI. Just to come back to your previous point, Stephen, about the growth in dividend payments, we expect that as the economy picks up, the corporates pay dividends. Yes, those dividend outflows will accelerate again. Give it a few years, probably back to that 70 billion mark. And that feeds into a broader story of a current account deterioration. If you remember from the fourth quarter bulletin from the SARB, we knew that we now know that the current account really dropped away at the end of last year. But certainly that is going to start expanding again. Dividends is a key component of that. And then investment spending, as investment spending picks up, suck in imports again and the current account deteriorates. And so that shows you from a longer term perspective why the currency, for instance, would have to come under pressure. I
mean, what's your view on the rand for this year, and are you looking at dividend outflows when you're coming up with that view for the rand this year?
No, as I said in the beginning, dividend outflows, it's really a structural issue. It's not going to drive the currency in the short term whatsoever. Our view at Rand Merchant Bank is still for currency strength this year. We've got 670 and dollar-rand target for the middle of the year and a very strong target of 7 at the end of the year. A whole year of continued rand strength at massively overvalued levels.
But isn't it, sorry to interrupt you, but isn't it a function of rates in the developed world? You know, if we see rates start to tick up there, won't people be thinking, you know, outside of that search for yield and start to look more inwardly focused, as they have been doing?
Well, we already now know that the ECB is about to hike rates probably next week. It's not having a major negative effect on the markets. Probably the larger concern at the moment is the pickup of inflation in emerging markets. Interest rate increases, fears that the growth will slow down. But as you say, eventually the Fed will start to hike rates, and that can be a turning point for the global markets.
But not this year.
I don't think it will. I don't think many people think really the Fed's going to be this year, although we could be in for a very volatile time in the next few months with the end of QE2 that comes in June. You know, the market's really going to have to adapt to that new situation.
How would you see the market adapting to the end of QE2, Sasha?
Yeah, look, in my view, I think it's a little bit overstated because the Fed has been in a position where they've wound down some massive programs kind of post-Lehman Brothers collapse and quite effectively. So, you know, whilst it's all happening in the background, it might sound like a lot of money, you know, $700 to $1.5 trillion, and it is a lot of money. But you know, compared to, say, for instance, currency flows on a daily basis, what is it, like $4 trillion? $4 trillion. So you know, the Fed's inflated balance sheet concerns many economists, and they wring their hands a lot. But in truth, there's a lot of money still sloshing around that I guess they have to absorb. But I don't think they'll be stupid about it. You know, I mean, I think they'll have a look at the employment, and we've got a reader again this Friday, and have a look at, and there are early signs that employment situation in America is starting to pick up, and then they'll have, you know, a few more arrows in their quiver and say, okay, guys, we're going to get to a point where we have to start raising interest rates pretty soon and exiting these programs.
John, do foreign exchange controls have any impact on dividend inflows or dividend outflows?
Well, only in the extent that foreign exchange controls have limited institutions' ability to invest offshore. Of course, if they had invested offshore, we would be getting a lot more dividend inflows. And we are, I mean, that's a bigger story. There's a discrepancy here, an imbalance building up. The amount of foreign money that's invested onshore relative to the little amounts of money that we've invested offshore. It's a reflection of multiple years of current account deficits and a reflection of these restrictions from the exchange controls and limitations on taking capital offshore. It's a negative for the rand in the long term.
And as we saw those forex controls relaxed last year and those limits lifted for institutions investing offshore, have they been taking advantage of that?
Well, we still don't have any firm data from that because the fourth quarter balance of payments is there's not enough of a period, an overlap. We'll have to wait for the first quarter data. But probably all the anecdotal evidence suggests that they are starting to do that, although the measures that still have to come into place. The change to the Pension Funds Act, for instance, still needs to come through before a lot of the institutions can really take full advantage of that.
Sacha, we know some countries have dividend withholding taxes, such as Switzerland, and that affects Richemont, which is listed in Switzerland as well. Is that something that the authorities would potentially look at? Do you think it would be welcome if they were concerned about these dividend outflows, or would it be a deterrent to inward investment?
You know, I mean, we get a lot of clients who get irritated about this specific issue. You know, the Swiss authorities have gobbled up a portion of our dividends. You know, what do we do? And it's a long, arduous process for them to be able to go and claim it back. You know, it takes multiple numbers of years. So I would think it would be a deterrent in quite a fluid market, which ours is. You know, that's a much more developed market, even if it, you know, at a sizable level, it's not a huge market. But I must say, when we're investing in Richemont, we don't invest in it for its dividends. So any sort of dividend taxation, such as the Americans have, would be frowned upon. But I think it's coming.
So the long and the short of it, though, if we want to be part of a global market, we have to see these dividends flowing in and out of the country.
Competitive, yes.